Hey guys, it's Cody. Now, I've seen this question come up a lot recently, and that is, should I get a mortgage on an investment property even if I can pay cash? And it's a great question, but it comes with a lot of variables. Today, I'm going to give you my take on the issue and share with you why you should never pay cash for an investment property if you're looking to grow and add more real estate to your portfolio. After watching this video, you're going to have 6 reasons why getting a mortgage is better than paying cash if you're looking to add more properties to your portfolio, and you can use that information to make sure that your money is working hard for you and so that you can get the highest and safest return possible. So let's jump in. Now, regardless of where the money came from, whether it was an inheritance or you just have a high income or maybe properties are just really cheap in your area, it's important to remember that you need to keep in mind where your money is best used and where it can produce the highest return possible. When determining your investment strategy, it's important to remember that the higher your potential return, the higher your potential risk is on that investment. And that's why the safest investments out there, like leaving money in the bank, produce such a low return. On the flip side of that, you have investing in a business which can produce massive returns but also comes with a lot of risk. So in the end, it's up to you to determine what your risk tolerance level is and how much you want to put into a property and how safe you want to make that investment for you. So again, guys, I'm going to give you 6 reasons why a mortgage is better than paying cash. Reason number 1, guys, is going to be a higher cash on cash return. When you invest in a property and you pay cash, your return on that money is going to be lower than if you were to put a smaller amount of cash in and get a mortgage. For example, a good investment property in my market is going to cost you about $275,000 and it would rent for about $1,600 a month. I should also point out that for this example, I'm not going to be taking into account repairs or taxes or insurance, because regardless of whether you pay cash or you get a mortgage, you're going to have those expenses that come up each month or each year. If you were to pay cash for a property like this, it's going to give you about a 7% return, and that's by calculating $1,600 per month times 12 months divided by that $275,000 investment. On the flip side, if you put 20% down and got a mortgage for the remaining $220,000 at 4.5%, your payment would be about $1,115 per month, leaving you with about $485 a month in net cash flow. So you want to take that $5,800 in cash flow each year, and you're going to divide it by the $55,000 for the down payment and a little bit more for your closing costs on the loan, and that's going to give you about a 10% cash on cash return. Now, this is about 3% higher than if you had just paid cash. Now, there may be an opportunity for you to put even less money into a property. If you go to a local bank or you go to a local credit union, a lot of times they'll have portfolio products that only require maybe 15% down or 10% down even, and you can get into a property for a lot less. Your cash flow is going to be less because your mortgage is more, but you're going to have a higher cash on cash return. You can easily hit 12, 13, 14% even. And of course, let's not forget house hacking. You can get into a home for no money down or very limited 3.5%, maybe 5% down on a home if you choose to live in it first and stay there for a year before moving out and then renting it. Reason number 2 is that you can put that money to work for you somewhere else, and it can earn a higher return than what you're going to be saving by paying the interest on a mortgage. Let me explain. So the S&P 500 has averaged about 8% when you look at the history of it over the last 100 years. And right now, interest rates on a mortgage are going to be about 4 to 4.5% depending on your situation and your credit profile. This means that if you invested your money into the stock market over time, especially over the next 30 years, you have a pretty good shot at earning about a 3.5 to 4% spread on your money when it's invested in the stock market rather than being invested into the property. This 4% spread could be worth over $500,000 in profit if you took $220,000, invested at 8% for 30 years. Now, one other thing that I want to point out is that you don't have to put your money into the stock market. You could continue to invest in real estate, which leads me into reason number 3. splitting up the money that you have and using it to invest in multiple properties. If you're putting 20% down on a property, this means that you could potentially buy 5 properties instead of just one by paying all cash. The number one thing with this is that it diversifies your portfolio into numerous properties as well as into potentially differing markets or cities. So what that means is that if one property has a problem, maybe you can't get it rented or the tenants are a problem, you've got other property to hedge your bets on your monthly income. This also gives you the ability to have multiple properties appreciate in value. For example, let's take that $275,000 house and say that it appreciates at 10% over the next couple of years, and then you decide to sell it. If it went up 10%, it's going to be worth a little bit over $300,000. If you just have the one property, you've now gained about $25,000 in equity, as opposed to having 5 properties that all gain $25,000 in equity by going up at 10% appreciation. This is the difference between $25,000 and $125,000. Moving on to reason number 4, one of my favorites, the debt is paid down by the tenant. Let me explain. When the tenant makes their monthly payment, they're going to be the ones paying down your mortgage every single month. So your mortgage balance is coming down and you don't have to do anything to make that happen. If you pay cash for a property, this isn't going to be an option for you because you don't have a mortgage. So it's nice to get that monthly cash flow as well as have your mortgage paid down each month by your tenant's rent. And the cool thing is, as long as the property cash flows, you have no part in paying down that principal on the mortgage unless you decide to add additional payments on top. Reason number 5 is going to be tax benefits, like writing off the interest that you pay on your mortgage. As of right now in the tax code, you can take the interest that you pay on your mortgage and you can actually write that off of your taxes so you don't have to pay money on what your mortgage interest expense is. Again, if you pay cash, this is not going to be an option for you. This is going to be something that you miss out on and you're not able to utilize. And really quick, guys, before we jump into number 6, which you're really going to want to hear about because it's something that not many people talk about, if you would, just click the like button below, hit subscribe to the channel, and the little bell if you want to get notified when I drop videos like this. And of course, as always, I'd love to hear from you. Drop a comment in the comment section below. I promise I'll get back to you. And number 6 is going to be the future value of your cash due to inflation. Now, this can be a little bit of a tricky topic, so let me explain. Over time, as inflation occurs, things get more expensive. This is the reason why homes have gone up in value. This is the reason why cars are more expensive, land is more expensive, gas is more expensive, food, just about everything in our society has become more expensive. Now, this also applies to incomes. Just because incomes haven't increased in recent history doesn't mean that it's going to continue to stay that way. At some point, incomes are going to have to go up. When you get a mortgage today, you're getting a mortgage based on what your income is at this point in time. However, in 20 years, 25 years, it's very likely that the money that you're making, even if you stay in the same job, the same position, and everything else stays the same, there's a very good chance that the income that you're making is going to be higher in the future than it is today. What this means is that you're paying a loan that was originated years ago with money that is now worth more than what it was when you purchased the mortgage. What this means is that it's now easier to pay down your mortgage because your incomes have likely gone up. This is the same reason why maybe 30 years ago your parents bought a home, they paid $60,000. Now the home's worth $250,000, but because their income was much lower 30 years ago, perhaps they were only making $20,000, $25,000 a year. Now they're making $50,000 a year. So it becomes much easier to pay down that original $60,000 balance if they still have that on the property. So that wraps up all 6 reasons of why I think that getting a mortgage is better than paying cash. I'd love to hear your thoughts on this topic. I'd love to hear if you're paying cash for your properties or if you plan to get loans or have loans on the properties that you do have. And I'd like to start a discussion about what your pros and cons are to getting a mortgage versus paying cash. Again, guys, I'd love to hear from you. Drop a comment in the comment section below. Click the like button on the video if you would, and until next time.